Welcome, welcome, welcome to another edition of Wealth Strategies. And I got to tell you, if you listened to last week's podcast, you're going to be super excited about this one. And if you didn't, make sure you go back and listen to it. This week, we're very, very fortunate to yet again have Marianne Bartels, Chief Investment Strategist with Sanctuary Wealth. Marianne, thanks for joining us.
Oh, it's my pleasure.
I'm going to hit just really, really high points so that people who aren't aware of who you are, you've had a fantastic career, one of the leaders in the industry over the last 35 years, winner of numerous awards. Business Insider just gave you a new award that I forgot about.
The Oracles of Wall Street. They nominated 11 people. I was one of them for my forecast last year.
So we are in royalty, right? So thank you for taking this time. You see, you're on CNBC, Fox Business, Bloomberg on a regular basis, as well as quoted in all the investment news. And so thank you. Last time we talked, Marianne, we talked about what can go right in 2025. And that story is very, very compelling. It's really difficult to shoot holes in it. But there might be some risk.
You always have to have an open window. You always have to know when you need to exit.
So what can go wrong in 2025?
There's a few things. Inflation has been sticky. And if inflation was to turn and really start going up, it would cause the market to start pricing in that the Fed would have to reverse course and raise interest rates. The market wouldn't even wait for the Fed to raise rates. It would anticipate it. And that could cause quite a sharp sell-off in the markets.
So let me ask you. I'm sorry. Let me ask you a real quick question about that, because this is something that I've been thinking about. When you go back and look at the numbers with CPI and the inflation numbers, it seems there's two areas that are really, really sticky: housing and healthcare. So let's just talk about housing. When you look in light of the number of homes that have been destroyed in California, housing prices, because of the rebuild and everything that's inside there's going to be increased demand, and more demand than supply raises prices. Can it be, how will that have any effect on inflation?
We don't know, because it's just one state and we have 49 other states.
Okay.
So just that one pocket may not be enough, but it's certainly something to watch, right? It can be problematic. There are economists that are looking to see if it's going to impact the unemployment number. Are people going to be unemployed because of this, right, in terms of these dislocations? I don't think anybody really knows the answer yet. My sense is, if it's going to have an impact, it's still probably close to a year away. Governor Newsom has stated that they think it's going to take up to 9 months just to clear the debris. And we know estimates tend to not necessarily be on target.
Right.
So the whole cleanup could take a whole year. Think about that. So you're not going to get necessarily a rebuild. What is happening is people are dislocated, having to move. Rents are going up illegally. California has a law that says that during times of stress or disasters, you can't price gouge, and you can only go up by 10%. And they are finding, in terms of rents and housing, prices are going up faster, but they're saying that they're going to prosecute if you do that. So they're trying to stop that from happening, but we won't know if that will have a problem. Probably not a sustainable problem. It's probably a one-time event. So numbers are year to year. So it doesn't mean that it's a constant going up. It's a point in time, maybe a month or two. But certainly economists are going to be on the lookout for that. I suspect, my gut tells me, once they start building, we're going to have to look for where we're going to get firming and pricing. I think you are going to get firming and pricing.
Okay. So inflation is an issue that could derail 2025. What else?
So tariffs. right? That's the big concern and big unknown. Where are the tariffs? What's going to be the impact, or more importantly, how's the market going to respond to those tariffs, right?
Right.
Remember, markets are discounting mechanisms. They don't wait for the event to happen. They try to anticipate the event. So if they don't like what they're hearing in terms of tariffs, you could get sell-offs. I don't think a bear market per se. I mean, I've heard things 25% tariffs across everything. I don't think the market would that's like a 15% sell-off. Don't
Right.
think markets could handle that one. Um, I think there's a lot of rhetoric and tone that's used for negotiations. And I'll give you a great example. Look at Meta. Meta just did a 180-degree turn
Right.
in terms of their policy after Mark Zuckerberg went to Mar-a-Lago. Um, so I think if it's more selective in how it's done, I think markets will be able to tolerate that. And again, looking at the past period of Trump being president, we didn't have inflation from his tariffs
Right.
across the board. So, but again, that's the what if the unknown. It's a known unknown that the market it will be watching very closely. The other thing that we have to watch closely is the national deficit debt ceiling. We're going to come up against a debt ceiling. We've never had bear markets from debt ceilings. We get minor sell-offs. They fix the debt ceiling and markets come back. So that's a little bit of bucking. And normally not a very big buck. It's normally in the range of around 3 to 5%. But the big concern that you have to have is because we are an indebted nation and we rely on outside investors funding our deficit. You worry about bond vigilantes. And what are bond vigilantes? They go out and sell bonds and have interest rates go up. And if interest rates go up, I think markets can handle 5%, 5.25, maybe even 5.5 if it happens gradually
On the 10-year?
on the 10-year, on the back end of the curve. I would argue we could probably even handle 6% if it's done right. Because when we look at history, 5 to 6% is considered normal. I
Right.
know it doesn't feel normal because we were at 0, but in history, 5 and 6 are actually normal.
Right.
My dad's first mortgage was 6%. So, and that was back in the 1960s. But if you start going 7, 8, that's a game changer. I think the way I look at it, as long as people want to put money in this country and have confidence that we can pay our debt, that we're willing to pay our debt, it's not a problem. I always tell people you can stay in debt as long as you keep paying your debt. You're going to pay fees and everything, but as long as you keep paying that,
You're
who
good.
cares? You're paying
Right.
your debt. And as long as the United States, they believe we can pay our debt over time, not a problem. Uh, Besant, who will be coming in, I believe, as Treasury Secretary, he's been known to want to fund at the long end of the curve. If there's no demand for funding, that can create some volatility, not necessarily a bear market. But these things we're going to have to watch. We're going to have to watch debt ceiling, and how the market and foreign investors are handling our level of debt. But I want to remind people, because no one talks about this. Let's go back to Clinton. Let's go back to the 1990s. During his administration, he inherited a deficit. The CBOE, who does the projections, never projected that during his presidency we would go to a surplus.
Right.
But we did go to a surplus. And why did we go to a surplus? Because of all the new innovation and technology. Creates productivity. You can grow your way out of your debt. This one's a little bit more of a hurdle than where Clinton was. And the last time we had a surplus was with Clinton. But we can lower the deficit just by growing. And we're already seeing companies willing to commit sizable dollars to the United States already. And I think that that's a testament of how the world perceives the US and where the innovation is taking place.
You mentioned this a second ago about interest rates. And last year, with some research that we read and some research that we did on our own, was that when you go from an inverted yield curve to a normal yield curve, at about 4 months later, you end up in some form of a recession. We just recently have gone really from an inverted yield curve to a normal yield curve. What are the odds of a recession happening?
So that's a great question. Did you know 100% of the time when we went to an inverted yield curve based on history, we had a recession? And we haven't had a recession. I think the models have changed and shifted. And remember, I come from a background of building models and using models, and I have a background in economics. Going to zero interest rate policy twice. You have to remember, we went to zero interest rates during the financial crisis, and then we did it again during COVID. And then the Fed raised its balance sheet during the financial crisis. I think before it started, we were under $1 billion in terms of the Fed balance sheet. And that went up to 3 trillion.
Right.
Came down, and during COVID exploded to 9 trillion. Right? You have to remember the world shut down. The Fed didn't know it's unprecedented. Zero interest rates, $9 trillion balance sheet. That is so unprecedented. That is liquidity. We always say like on steroids. I would say it was steroids on top of steroids. And we don't know how to model that.
Right.
The models, you can't go back and say, well, when we do this, what happens? You can't even go on ChatGPT and say, when the Fed went from a balance sheet of basically some billions to 9 trillion, what happened? It's going to come up empty-handed because it never happened before. I think Fed policy has altered our economy in ways that we don't know how to model. So the models are not working.
Yeah, well, you go and think, I think that makes perfect sense because, in the 90s, prior to the 90s, you never saw 0% interest rates.
Only other time you saw that was in the 20s. During the during the Depression, during the 30s, excuse me, not the 20s, during the 30s. For a brief time, we had zero interest rates. And you have to remember, part of the rest of the world went to negative interest rates.
Yeah, that wasn't for just a couple days, couple weeks, a couple months. It was for a long, long time.
The world went to levels of interest rates we have never seen in history.
Right.
That has to dramatically change how economies respond. And I believe that's why the Fed is data dependent. Right? They keep saying they're data dependent. We really should be forecasting. The Fed should be giving us long-term forecasts. They're not. They're saying, well, it depends on how data comes out. Well, what does that tell you? They don't know what the long-term models are. They can't say that because the markets would crumble.
Huh.
But I think it's because we're really not sure how all of this liquidity has transformed. But I will tell you what I believe it has definitely done. We're no longer in a deflationary cycle. In our lifetimes, we will never see zero interest rates again. That's done. We are now in a rising interest rate environment. Right now, the phase that we're in is normalization. But I do believe 10, 15, 20 years from now, we're in an inflationary cycle.
Gotcha.
At some point in time in the future, we will have 10% interest rates again.
Well, there's some people that are looking forward to that and other people that are terrified, right?
Well, if you want income, that's a good thing. But it's really about, we got through the 70s and the early 80s. You have to remember, interest rates went to 18%. Yes, you did have a harsh recession in there. But for those that need income, you just stay at the short end of the curve. You just keep rolling things over, right? It's called laddering.
Right.
You just keep turning it over. But I don't see that happening in the near future. But in the distant future, I do see that happening. I think businesses need to understand that we're not going to zero again, and that we're normalizing interest rates now, but the risk is over time, inflation creeps in and rates will have to go back up to levels that are somewhat uncomfortable.
Do you think that this market is, it's interesting you said that because the Fed's making all their decisions looking on backwards information, right? The only data that they have, they're not really spending a ton of time forecasting. And the Fed, you could state a case that they've done, though you may or may not, that you may think that they were a little bit late or a little bit early or whatever. Overall, they've gotten a lot of things right. As we're kind of looking forward here, what the biggest risk will be that the markets. My take is that we have headline risk that could cause things to go through to happen.
I think it's more headline risk, more of the bucking bull, than anything that's going to cause a dramatic decline. And when I say a dramatic decline, on the S&P 20% or more, right? NASDAQ goes up more, so it goes down a little bit more. But a traditional bear market is marked by 20%. A tech stock that's up 300% could go down 20% in one day, and it's a hiccup. So we got to be careful with some of these terms. But in terms of the general market, I don't see a bear market in the horizon. In fact, I've actually stated I wouldn't be surprised at some point if we print a 5% GDP number. Now, the bond market's not going to like that, right? The bond market, especially the 10-year treasury yield and the 30-year, would not like a number like that. That's like too fast a growth. But if we can stay in this range of 2.5–3%, we're in Goldilocks. I mean, we're really in a Goldilocks situation. Capital is ample. There's no constraint on capital. Companies are growing their balance sheets. Their profit margins are improving. The return on equity in tech is superior. It's an outstanding time for the markets. And I really do believe in my heart, between now and the end of the decade, there are going to be some clients that can double their portfolio. Now, you're going to have to take risk in order to do that, right? This is not your conservative portfolio. This is more an aggressive style portfolio. I think those portfolios can actually double going out to the end of the decade. My long-term forecast on the S&P is for the S&P to go between 10,000 and 13,000.
Wow. So, one of the things and kind of going through and looking back at what's happened over the last 2 years is you take the S&P 500, the equal weighted S&P 500 returned about half, which tells us that it's a very narrow market. It was pretty much to a certain extent, the only show in town was technology. Are we starting to see, and a broadening market is actually healthy? Are we starting to see?
We did have a broadening out of the market last year, and you can measure that through the breadth of the market. We did start seeing expansion. And I do think we can get expansion this year, but I do think it's going to stay very top heavy. I think the performance is going to come out of the much larger, what I call mega cap stocks. I don't see that changing. And here's the key. Your leadership is technology and tech related. The day that you lose your leadership is the day you lose your market.
Gotcha. So
that's your indication that the bear market is coming.
In bear market, but a correction doesn't mean bear market, right? And so,
no, correct. We have to be careful with the term secular bear, cyclical bear. A cyclical bear, meaning a market that goes down 20–30% in a secular bull market goes up to go on to all-time new record highs. In a secular bear, you don't go back up to a new high. And here's another key that your listeners are not really going to want to hear. But when we go into a secular bear market, history shows we go down 50%. Wow. You lose half of the market.
So if we're at 10, that goes down to 5. Yeah. But that's not, we've got time. You make hay while the sun is shining.
We got a lot of time. I still think portfolios can double. The aggressive portfolios can still double before we have to face that.
So what sectors give you the greatest concern as we're looking forward here in 2025? If any, the answer may be none.
They don't give me a concern, but what I have to watch, what I have to be vigilant is, does my leadership stay leadership?
Mm.
Right? Does tech stay leadership? Because if it doesn't stay leadership, I've got a problem. Right? I expect it to remain leadership. I have very high confidence level in that. But should I be wrong and we lose the leadership of tech, we're going to have a major problem in the market. So I watch that vigilantly. That's something I really, really watch. I'm not worried about oil prices, but what I've told people, especially when we've had geopolitical wars that unsettle investors, it's not until you really get above 100 and stay above 100 and I'm using WTI, not Brent, that you really cause a major structural problem. And I don't see that happening. And especially if we're going to become energy independent and it's drill, drill, drill. I don't see that happening. But that would be problematic. Be good for the energy stocks, but temporarily, because when markets go down, it takes generally everything down, except for gold. And that's one thing we have not talked about. Gold and gold mining stocks generally are the hedge in a portfolio when markets go down significantly.
And is there opportunity? Should we be?
So my long-term forecast on gold is to go to 4,000. Gold is used for a lot of different reasons. One of the reasons why I think it's going up is because we've started an inflationary cycle. So I do think part of it is inflationary. Gold also goes up as interest rates go down, and we've seen interest rates go down because cost to carry goes down. So I like gold, but I will tell you, if you want it as a hedge, when things go wrong, you never own enough of it. You never. When things are bad, you're not going to put half your portfolio in gold. I mean, there might be some people that do, but the average person doesn't do that. So I think owning some gold to diversify your portfolio is fine. But on average, most people, put anywhere between 1% to 5%, which means it's not going to hedge all that much of a portfolio in a downturn.
So talking about diversification, one of the things, 70% of the global economy or something like that is outside of the United States. International, is that something that could go wrong this year? Go wrong in 2025?
It's already gone wrong. You already got problems. You already have political problems across Europe. You have economic problems. They're not growing as fast. You have political problems to the north in Canada. China is a mess. But there's two spots that I've pointed people to: India and Japan. But here's the thing. I do expect the dollar to remain strong. Our interest rates are going to stay high relative to the rest of the world because their rates are going down because their economies are weaker.
Right.
So dollar trades on what's called interest rate differentials. Money coming here to invest in the market, money coming here to invest in technology will strengthen the dollar. So when you translate your portfolio, you lose money. In Japan, I think Japan is reinventing itself. It has corporate governance again. I think it's going to become a manufacturing hub. There are ways to hedge through ETFs. Wisdom Tree does have an ETF that helps hedge out the currency risk. I'm not aware of an ETF for India. So I'm not seeing a lot of opportunity outside, but very selective opportunities.
You mentioned tariffs being a risk. Is there any other policies that the new administration could flip the switch on that could wreak havoc in the markets?
You have to wait and see what your Treasury Secretary does in terms of funding the deficit. That's which we talked about, how they're going to structure that. I think that's more of a bucking bill story than anything. But you have to, I mean, if you're going to take a positive, these are Wall Street people. They're going to understand what the market's going to do because they're going to float this. They're going to talk to their people. They're going to know how the market's going to position based on some of their policies. So I'm not as concerned about that. So, but something to watch. There's always something to watch. What could ruffle things? I think President-elect Trump has a way of just saying things off the cuff and
You're
and and,
kidding.
and then rephrasing them.
Right.
So depending on what he says in the moment, you could get a ruffle, but then it can get dialed back.
Right.
So I think it's that part, I think the administration is going to make for a very interesting year.
The so you mentioned this, and your case is rock solid, and that is the leadership in this market is technology. The challenge is that when technology is no longer the leader, you're already going to be halfway down the road, right? Before you go and click that button. Is there any other kind of warning signs that people should maybe say, hey, let's hit pause and just make sure we're taking the appropriate amount of risk?
So when you really start having euphoria, like when you're at a dinner party or you're at some event and everyone is talking about being vested in the market
Right.
and whatever the hot stock is, everybody's bragging about it. That's a sign. When the cash, we have $7 trillion on the sideline. When that starts getting significantly 50% or more starts getting deployed, we have to watch. And then at the top of markets, because there's so much confidence and euphoria, people leverage. The markets get leveraged. So you have to look for that. And if there's a lot of leverage in the market, that's another warning sign. And I don't have any of that.
Well,
I'm not
and
even close.
none of those things right there happen in a 9 month period, right?
No, it normally takes a few years.
Yeah. So
I mean, this is a really good story. If you go back to the late 90s, Julian Robinson, I believe that was his name, ran Tiger Fund, founder and runner of Tiger Fund. Brilliant man, great company. Didn't like the internet stocks, didn't like the valuations. They were crazy valuations, over 100 times. So he started shorting the market. He shorted too early and actually put his company out of business.
wow. Yeah.
Valuation does not time a market.
Mm,
So now, if you had just gotten out of the market and didn't short, you would have been a little bit early, but you wouldn't have gone under. But the shorting took them under because they were a hedge fund. So even when we start seeing euphoria, it can take time. And so it's normally a number of factors we have to be watching: cash levels, margin levels, sentiment, what we call sentiment levels, to call a top. But if my forecast is correct of 10,000 to 13,000, getting out, early, won't be a bad thing because the downside of 50%
right.
would be greater. But again, I don't see that until 2029, 2030. And again, that's an estimate, a guesstimate based on market cycles. So we're going to have to wait and see. But I like having a runway, a timeline of where we're going. And it's like a business plan, and we can adapt and change it. If it happens sooner, we'll call it. But at least we have a guideline of where we think the investment cycle is. But just as a reminder, when we look at markets going all the way back to the 1800s, markets here in the United States are biased to the upside,
Right.
right? So if you're a young investor, you don't want to be timing these markets. You have a lot of runway. Where it gets a little bit more challenging is if you're in retirement or close to retirement, you want to narrow up your risk profile to protect those assets.
Right. Marianne, just to kind of wrap this up, I don't want to put words into your mouth. From an investor's point of view, what could go wrong in 2025 would be when we have moments of volatility for you to think that the end is here or the sky is falling and not to stay invested or not to continue to participate. Is that fair?
Correct. Every study on Wall Street and every study on academia will tell you to stay invested. This is a journey, right, to grow wealth. It's not, a 1 day, 1 year kind of wonder. And what happens to a lot of investors is they become emotional. And
Right.
I understand that. And when we let our emotions drive our behavior in terms of markets, we often make mistakes. But what studies have shown is if you work with your financial advisor and you have a plan and you understand that plan, when markets have that extreme volatility and go down a lot, you're less likely to make a mistake.
That's right, especially if you have peace of mind of knowing what's next, right? And you have
Correct.
great resources.
And you understand why you're positioned the way you're positioned. And, for those that are collecting cash flow, I've seen oftentimes where cash flow is going up as the portfolio value is going down, which sounds really strange, right?
Right.
But that is possible. So it's really about really working with your advisor and having that plan, revising it when appropriate. But if you have that structure and plan, you're less likely to make a big mistake. And I can tell you, I have met clients that sold at the bottom of 2008 and 2009 and never went back in.
Oh, you just can't recover. You just can't recover.
You will never recover that. So the last thing you ever want to do is panic.
So we're going to have a little bit of, there's a potential for volatility. We could have some things, but they'll probably just be little blips. A 10% correction isn't necessarily something that's bad. And I know we started this off talking about what could go wrong, but there's a whole bunch that's going to go right.
There's a whole bunch that goes right. And every good cowboy that rides a bull, what do they do when they fall off? Even if they
Cover
get
their
hurt,
head.
right?
No.
They go right back up again.
That's right.
So, when the bull bucks and you feel like you're falling, you just got to get right back in there. Again, buying low is hard. Buying low means you're buying on bad news. Remember,
Right.
There's no good news when markets are going down. None. In fact,
That's
it's
right.
horrible. And when markets are going up, you never want to sell because it's such good news. But rebalancing a portfolio, right? If because stocks are up, 20% or more over, 2 years, maybe your equity allocation is a little out of whack. So maybe you need to readjust your portfolio. So there's nothing wrong with rebalancing a portfolio. Even when markets are going up, it's an appropriate thing to do. All academic studies will tell you that that's the appropriate thing to do. Portfolio managers do that in their portfolio. Most portfolio managers are rebalancing anywhere between 2 to 4 times a year.
Right.
Because things can get out of whack in a portfolio. But if you can keep riding the bull and stay steadfast, history has shown that due to the returns and the compounding of dividends, you're going to turn out to be a really big winner.
Awesome. Marianne, I can't say thank you enough for taking this time, both last week and this week, and I look forward to having you on in the future. You know what? I would be remiss if I didn't give you the opportunity to anything else that you think's important.
No, I mean, I think we covered all topics, and what AMPI always taught me was stay invested.
Right.
And stay with good companies.
Awesome.
That was what she told me.
Well, thank you. I know that our listeners and the viewers absolutely love having you here, and you made us all better. And so I just want to say thank you, and look forward to having you on in the future.
Well, I really appreciate the opportunity, and I look forward to coming back and being on your program.
Awesome. And for everyone, thanks for joining us, and we will see you next week.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC. an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities Inc. and Sanctuary Advisors LLC.